Like Beth said, I'm Ashley Four. I'm a senior manager here at Frailing Anderson, primarily focusing on the audit and assurance side of things. And today we are going to be talking about the very riveting topic of the new lease standard. So that's what we are here to talk about today. Feel free to, like Beth said, send a message if you have any questions, or if you need to unmute yourself if you have something you want to more clarification on right away, let me know. I am primarily going to focus on the lessee side of things, so the people renting something versus the lessor side of things, as there really wasn't any changes on the lessor side of things for accounting purposes with the new standard. So that is going to be the primary focus today. So with the new lease standard, just a little bit of an introduction. So the standard requires substantially all new and existing leases to be put on the balance sheet at the net present value of the fixed rent payment. So under old standards, we were only putting capital leases on, or putting operating leases. So operating, think like a building that you're renting, or a printer, or a vehicle. Those are kind of some big examples of the most common operating leases. So now all of those leases are going to be put on the balance sheet. And this standard is effective for years beginning after December 15th of 2021. So if you're on a calendar year, that's just going to be 1/1/2022. So this reporting year that we're in right now. And why is this important? Well, it could impact our debt covenant significantly, and I'll touch base on that a little bit later here about some examples of some debt covenants that could be impacted, and why this might be important for you to consider and look into and have conversations with your banker regarding it. And just one note is that there's no exceptions or differences for related party leases. I know a lot of, especially our clients, they own the building that the operating company is renting from, and there's no exceptions or differences. The standard just says that any legally enforceable lease falls under the standard, so even with a related party. However, there are a few exceptions to the rule, meaning not every contract is considered a lease. So one example would be any short-term leases, and short-term meaning 12 months or less with no purchase option. However, you would need to consider if there's an extension period written in that lease. And if there is, you would have to, what the standard refers to is using hindsight when determining the lease term. So if you have a 12-month lease and you have, say, an option to extend the lease for 5 years, you have to consider if you are actually going to extend that lease, or are more likely than not to extend that lease to that 5-year period. And if so, that's no longer considered a short-term lease, even though the initial period is short-term. So, but if it is just a 12 months or less, that would not be considered a lease and put on the another exception to consider would be who controls the asset. So if the lessor still has control of the asset throughout the lease term, this would not be considered a lease. And then the last exception would be, can the asset be substituted at any time? So if the lessor has a substantive right to substitute the asset, it wouldn't be considered a lease. And I have there in parentheses a boat rack as an example. So if you are leasing a space to a boat rack to put your boat to, say, store it in the winter, but if the lessor can, move your boat to another boat rack or move it somewhere else to make it easier for them, that wouldn't be considered a lease, because there's no identifiable spot or asset where your boat is being held. So that's just kind of a simple one where you're sure you're renting a space for your boat, but it could be any space, so that would not be considered a lease. So because the place could be substituted at any time. And then so implementation of the new lease standard. So like I said, for our calendar year end, this is going to be as of 1/1/2022. So there's two options for implementation as of 1/1. If you're doing comparative financial statements, meaning you're presenting 2021 and 2022 results, you can retroactively apply it to the earliest period presented. So in that case, you would actually go back to 2021 and present it on that balance sheet there. Or there's an option to just apply the standard as of the effective date, so 1/1/2022, and recognize any cumulative effect adjustment to your opening retained earnings. And in this case, your financial statements aren't going to be comparative because 1 year is going to show a big right of use asset and lease liability and the other won't. And that's okay under the standard. They allow us to do it that way. And then to implement it, you are just calculating that right of use asset and lease liability at your net present value of the remaining lease payments. So as of 1/1/2022, if that's the route that you go. So under this new standard, there's two types of leases, one being a finance lease, which under old standards was called a capital lease. And then there's an operating lease, which, like I said earlier, that's think your buildings, printers, vehicles, etc. So the finance lease, previously called a capital lease, the criteria to recognize a finance lease and be considered a finance lease is substantially the same under the old standard. We have our 5 criteria here, where if there's a transfer of ownership term, or if there's a purchase option at the end of the lease term, like a bargain purchase price. So if you're leasing an asset and you have the option to purchase it for $1 at the end of the lease term, that would be an example of it qualifying under a finance lease. If your lease term is a major part of the economic life of the asset. And major, the standard doesn't define what major means. Around 75% would be kind of a go-to amount to be considered major. Or if the present value of the lease payment is substantially the fair value of the asset that's being leased. Or if the asset would have no use to the lessor at the end of the lease term. So those are our 5 criteria that you would want to look at to consider if it's a finance lease or an operating lease. And then here I just have a chart showing what our financial statement presentation looks like under the old standard versus the new standard. So under our old standard on the balance sheet, we had a fixed asset and a capital lease payable. And under the new standard, we still have an asset and a liability, and just the name of them is different. So the asset is called a right of use asset, and then the liability is a lease liability. So pretty similar for those. Our income statement presentation remains substantially the same. We have interest expense on that lease liability, and we have amortization expense on the asset. And our statement of cash flows presentation under a finance lease, again, remains substantially the same. We have just the cash paid for the capital lease under the old standard was in the financing section, and now we just have cash paid for a lease liability in the financing section of the statement of cash flows. So same presentation, just a different way of wording it on the financial statements. And then we also have amortization of the assets in our operating section of the statement of cash flows. Just to recap, I guess a finance lease, there's really not a ton of changes as far as how we're going to treat a finance lease versus how we were previously treating a capital lease under the old standard. And then, so then here for an operating lease, again, think your building leases or vehicles or printers, that kind of stuff. This is where we have a bigger change on, especially the balance sheet. So previously we were not putting any operating leases on the balance sheet, and here under this new standard, we're going to record a right of use asset and a lease liability on the balance sheet. And again, this is at the net present value of your remaining rent payments on that lease. And if you think about the building, that's where the amount can get to be a very large dollar amount. If you say have a 10-15-year lease on the building, it gets to be a pretty big dollar amount for that asset and lease liability. Our income statement presentation remains unchanged. We're just going to recognize rent expense on the lease. That's how we're amortizing asset and liability under the new standard. It's just all hitting rent expense on a straight line basis over the life of the lease. So our rent expense should remain unchanged under this new standard for an operating lease. And then our statement of cash flows presentation, that remains unchanged as well. Just all cash payments are included in the operating section of the statement of cash flows. So our biggest change here on that operating lease is just that balance sheet presentation, where we now have a new asset and a liability on the balance sheet. So how can Fraley Anderson help? A couple of options for how we can help you guys implement this new standard. One thing that we're doing is using a software called Lease Crunch. In this software, it's just a website that you go to. You have your own login. We have our own login, so we can see what you're doing on there. And you can add your own leases and that kind of stuff. And the software actually assists with provides us with journal entries under the new standard, amortization schedules, and footnote disclosures. So it's extremely helpful. We've already had a handful of clients start using the software to start implementing the new standard, and I've heard nothing but good things about it. It's very intuitive to use, and it comes up with everything. You can customize it to your GL accounts, so that when you print the journal entries from there, it tells you what accounts in your own GL to hit. And again, comes up with the amort schedule and the footnote disclosures, which are a requirement under the new standard. It calculates all of that for us. So it's very nice. So the Lease Crunch software is something that we're using for all of our clients to do this. So that's one way to do it, as opposed to calculating and coming up with your own amortization schedule for the leases. Another thing we can do, so this is where preparing compiled pro forma financial statements for third-party use. And like I mentioned earlier, a lot of our debt covenants could possibly be impacted with this new standard now that we're adding a lease liability and a right of use asset on the balance sheet. Like I said, if you think a building lease that's say 10-15 years, that dollar amount can get quite large. So just a few examples of some debt covenants that could be impacted significantly with this and cause people to go out of compliance with their loan covenants, like a fixed charge ratio. If the scheduled principal payments, that's one of the amounts in that ratio calculations, if that doesn't have an exclusion for the lease liability, that could cause you to go out of compliance with that. A current ratio, so with the lease liability, there's a current portion of that, so that could really increase your current liabilities, whereas your current assets remain unchanged with the new standard, so that could throw you out of compliance there. And then another one would be your tangible net worth ratio, because the right of use asset is not technically a tangible asset and the lease liability would be included there. So pro forma financial statements would be a good way to show a third party or even just internally how this new standard is going to impact your debt covenants, and start to spark a conversation with bankers about how debt covenants should change or be rewritten in order to stay in compliance with those covenants, because this is going to add a big liability on the financial statements and likely throw you out of compliance with those debt covenants. So Beth, have you seen any questions come in? I see a couple in the chat. Rick, I see Rick, you sent a message about month to month with related party lease with no written contract. So the standard says there's nothing in the standard that has any exceptions for related party leases, and it just says that a lease has to be legally enforceable. So if you have no legally enforceable contract in place, it is not considered a lease.
I don't see any other questions in the chat. Does anyone have any other questions, or there's Frailing people on here? Any comments to add? Really?
I know it's a very riveting topic, leases, so.
Well, you covered it well. Very well.
Ashley, quick question, it's Doris.
Hi, Doris.
So I can't remember, did you talk about Lincoln exceptions, gap exceptions for people at all, if they wanted to do that, depending on how many they had? So, and who this is all required for?
Yeah, so this is a good point, Doris. Thank you. So this is going to be required for anyone reporting gap financial statements. It's going to be difficult to do any sort of gap exceptions. It's going to depend on the materiality of the lease. But if you have a building lease, it's going to be quite difficult to issue gap financial statements with just an exception in there that you're not implementing this new standard. So say if we're doing an audit, we would not be able to issue a clean audit opinion if you're not going to implement this standard. So anyone with gap financial statements has to do this. There is a materiality threshold. So say if you just have a printer lease, you know, that's a couple $100 a month. You probably could get by without recording that on the balance sheet, but beyond that, it's going to be pretty difficult to get by without implementing this. So.
What are the charges for Lease Crunch software? See that one?
Yes, I did see that. So the charges for the Lease Crunch software is it's $100 per month per lease. I think I'm saying that right. Brandon, is that's correct?
No,
per month?
No, it's more like it's $100 per year per lease.
Oh, okay.
Yeah,
yes,
it's
right.
it's pretty affordable. Yeah, for what you get. With everything Ashley said, the calculation of the amortization schedules, the journal entries, the footnote disclosures, and all, not to mention the knowledge bank that software has. So yeah, $100 a year approximately.
And is that, Brandon and Ashley, is that just the cost of the software itself for our clients?
Yeah, that's right. That's just software.
How about, is there going to be training available to clients that do decide to do that, go that route?
Yeah. Yep. So there's training videos from the company itself, Lease Crunch, to show you how to input leases and that kind of stuff. They have videos that we can send out, and then any consulting work that we do, if they want us to add leases or help them in that kind of stuff, that would be billed at our hourly rates. But there are training videos from the software itself that show you how to enter leases. And it's really quite simple to add leases to that software, and it walks you step by step very well, and it actually helps you make decisions as far as, is it a finance or an operating lease, and what's the life of the lease. Like, it has guides in there to help you make those decisions as far as how the lease should be recorded and that kind of stuff, which is super helpful.
Is there a materiality element to this?
That would be on a client by client basis. So kind of like I said earlier, if all you have is a printer lease, like if the company owns their own building, et cetera, and all you have is a printer lease, it's a couple $100 a month, you could probably get by without recording that. But of course, you'd have to look at it client by client to see if it's actually material to the financial statements or not. Jane, I just saw your question come through about our lease print software expert. So I've used it quite a bit. And then Jacob Gregg, I don't think he's on here. He's one that has used it a lot as well. So feel free to reach out to me, Jane, and I can get you in touch with someone if I need to. If you want some help on it, or if you just want us to kind of show you what the software looks like, we can do a demo version of it and go from there.
Good question, Kathy.
Yes, Cassie, what was the impetus for this change? So the lease standard has been around for many, many years, and it just kept getting delayed and delayed. But the whole purpose of it was a couple. One, they feel it provides more clarity to the users of the financial statements to put the asset on the books that the company has a right to use. So they're thinking it's providing more clarity to the users of the financial statements, and then also to align with international standards. So the international standards have had this in their standards for quite a while. So it was just came about to align with the international standards for financial reporting.
All right, any other questions?
I guess I did. This is Scott from Murphy. I don't know. I guess I was just wondering on the, I'm thinking of like building leases.
Yep.
The non-component aspect, like the property tax, is that just considered variable lease expense? I didn't know if there's any reason that we would need to separate that on like the income statement as compared to other variable, like the common area maintenance.
Right. Yep. That would be considered a variable lease expense. So you wouldn't include that in your calculation of that right of use asset and lease liability at the start of the implementation of the standard.
Okay.
And same with those CAM charges.
Okay. Thank you.
Well, this has been helpful. Thank you so much, Ashley, and everyone who's been adding in here. Just news, our next webinar is December 21st. We're doing a tax update. And if you want to see our smiling faces in person on November 17th, we'll be at Forgotten Star for just a happy hour. No lectures, just happy hour. So keep your eyes open for that, and we hope to see you there.
All right.
I think that's
Well,
all we
thank
have.
you.
Thank you, everyone.
Thank
you,
you.
Ashley.
Thank you.
Thank you, Beth.
Thanks, Ashley.
Thank you. Thank you.
Thank you.